Some parents are screwing up and screwing their kids when they buy life insurance. Not you though. You follow me, Vivian, your rich BFF, and your favorite Wall Street girlie who's going to show you how to do it correctly. No surprise, birth or adoption of a new child is a pretty strong motivator to get life insurance. You want to make sure your kid's okay but a lot of parents are naming their kid as the life insurance beneficiary, which is a huge no-no. Reason being, minor children cannot directly receive the proceeds of a life insurance policy. Instead, the state would appoint a guardian if you hadn't done so, and that's a lengthy and costly process. Worse, that guardian would then manage and determine how that money is spent, and it may not be how you intended. Instead, you are going to open a UTMA account for your kid. Any financial institution can help you do this. You're going to name a custodian of your choosing. Think trusted relative or friend. And then list the UTMA account as the beneficiary of the life insurance policy. This will help ensure your kid gets your money and the government stays out of your business.
I can absolutely understand why this may be a good first attempt at figuring out an alternative to simply naming your children as the beneficiary of life insurance policies. However, it's probably not the approach that I would advocate for. And there's a few different reasons for it, and let's tackle each one. The first is the concept of the UTMA, UGMA account itself, a Uniform Trust to Minors account or a Uniform Gift to Minors account. These are financial accounts that are established for the benefit of a child while they are a minor. But there's no question about it. Those assets are actually the minor child's assets, right? If you have life insurance death benefit proceeds deposited into that account, that's just being custodied for the child while they're still a minor, and they lack the legal ability to make actual decisions that are obligatory, if you will, by signing their name to contracts and things of that nature, right? They can't on their own deal with the disposition of those resources. However, as soon as they reach the age of majority in the respective state where that account is formed, well, those assets are now 100% accessible by that child themselves, now that they're adult. And the problem with that is that means that those resources are also then available to satisfy the debts and obligations of that child. Creditors and litigants could go after them. And depending on how those resources are utilized, maybe even commingled with other relationship resources, like let's say in the context of that child getting married, then those resources are potentially now also subject to potential marital settlement in the dissolution situation of that marriage relationship that could occur. And I just think that most business owners, when they are fully informed as to the alternatives that are available, they probably would not select this choice. Now, I understand why some may want to go this route because of the low to no cost that's associated with a UTMA account or a UGMA account. Most financial institutions will allow you to establish them for, again, very, very low costs in most regards. However, the alternative that I would probably be the one advocating for would be the utilization of trusts. And there's a variety of different trusts, and I recognize that the complexities that are out there are pretty voluminous in themselves, right? There's more than 77 different types of trusts that exist in the United States. But they all boil down to one of two general types, right? Revocable and irrevocable. And I probably would advocate for, at the very least, having a revocable trust named as the beneficiary, because you can always change your mind in a revocable trust while you're alive, and once you pass away, that trust becomes then irrevocable, and all the provisions that you would be able to put into that trust then are set in stone, and therefore could be something that carries forward your legacy from the grave. And you can incorporate in a trust a variety of different provisions, because a trust is simply a private legal agreement that you would be establishing, right? You would serve as the grantor, and in a revocable trust context, you're also typically the beneficiary and the trustee of that trust while you're alive. At your passing, the resources that would be in there, meaning the death benefit proceeds, could then be utilized for the benefit of your child, whether they're a minor or an adult. And so long as those resources stay within the context of the trust, they're protected from outside forces, the enemies at the gate, right? The creditors, the litigants, even potentially relationships that falter. The reality is, so long as those resources aren't commingled with the child's other outright resources, they're not available to be attached by a creditor or a litigant in those sorts of processes, nor are they typically going to be available for marital settlement. So when you're looking at setting up your financial structure and the processes by which your money would flow, given a variety of different scenarios, whether we're talking about while you're alive or even at your passing, having a really good plan in place is the secret ingredient. And putting that plan in place with someone who is knowledgeable about all of the different ins and outs of the different alternatives that are available to you could go a long way to shortcutting your journey and making sure that your actual goals and objectives, the ones that you truly care about, are put into practice. These are the types of conversations that I have with clients all the time, business owners who are trying to figure it out, right? Figure out which strategies are the most applicable to their unique situations. Because in certain circumstances, a UTMA, UGMA may make a lot of sense, right? And in others, maybe the trust route is the better approach, and then figuring out which type of trust specifically. That's why you want to have conversations with people who actually know what they're doing and in the context of the strategies you're exploring. Now, I have no idea whether or not we'd be a fit in your circumstance, but I do know that you could find out by simply clicking the link in the description below. Complete a quick application, see whether or not we can add value, and if so, we'll see you then. Until next time, be well. Bye for now.